Thank you for joining us for this workshop on funding avenues in the Indian startup ecosystem. Funding and fundraising are both important modern business scenarios that aid in the growth of a startup. In addition to this, funding is required to take full advantage of the current and upcoming market opportunities. Therefore, this workshop aims to highlight the various types of funding avenues for aspiring young entrepreneurs and ways in which startups can avail the existing funding opportunities. To begin with this workshop, I would like to introduce our speaker, Mr. Rajan Anand, Managing Director, Search in Sequoia Capital India LLP. As part of the leadership team at Sequoia Capital, Mr. Anand is focusing on developing Search into the world's top scale-up program for startups by acting as an investment advisor and mentor to the program's founders. He's also a prolific investor who has backed a large number of successful startups at very early stages. Welcome, Mr. Anand, and over to you now.
Great. Thank you, Diksha. Good morning, India. I hope all of you are keeping well. I hope all of you are safe. It's obviously looks like we are back to a major COVID storm. I hope all of you, your families, and your teams are safe. All right. So what I'm going to do is I'm going to pull up my deck here, and then we'll get started. Second, guys. Okay, here we go. All right. Can you guys see my screen? Maybe Diksha, you'll have to tell me whether you can see it.
Yes, so we can.
It's not supposed to be done there. Okay, so now you're on slideshow. All right, cool. Okay, so you know what? The topic that I'm going to focus on is how to raise your seed round. I was told by Startup India that many of the folks who are dialing in are really focused on raising your seed round, and your seed round could be, you're trying to raise 50 lakhs, maybe all the way through, call it 20 crores, right? So seed today is sort of a pretty broad term, and I'll talk about a little more specifics on that. Now, to the extent you have questions about raising later stage rounds, be it Series A, B, C. We can also get into that. So please put your questions, just submit your questions, and then the moderator will kind of share with me some of the questions that you guys have, and then we'll get through it. All right, so let's get started. Okay, so there are three ways to really fund your company, right? And I think today, last year was a historic year for India. As an ecosystem, we had $35 billion that came into startups in India. A lot of it was actually for late stage financings. So as a result, everybody thinks that the only way to really build a great startup is to actually raise lots and lots of capital. Well, actually, that's not the case. There are three ways to fund your company. The first one is your business model. You can generate your own cash flow. These are called bootstrap companies, and we'll talk about some of those in a minute. And quite frankly, if you're able to build a business by financing your company through your own cash flows, quite frankly, that is a fantastic way to build a company. The second way is to actually raise funding by selling equity in your company or ownership in your company, and that's what venture capital and angel investors and so on and so forth. When you raise equity capital, you're essentially giving away equity from your company to actually raise capital. And then finally, it's debt. We don't talk about it as much, but there is a class of debt called venture debt that you can raise. Now, to raise venture debt, you actually need some equity financing. It's very difficult to raise venture debt. We would not recommend that you raise, if you're building a startup, that you raise debt from, let's say, classic debt providers like banks or even sharks. That's not a good strategy because, as a startup, you have to be very, very careful. But after you raise your, let's say first or second or third round of equity financing, usually a Series A is what we advise. You can actually explore debt or venture debt as a possible financing option, right? So I normally start with a question when I can actually interact live with the audience. But today I think we're live streaming this, so it's a little harder for me to get real time feedback. But I asked this question about what do these companies have in common, right? Zoho, Zerodha, Wingify, Fusion Charts, Basechimp. Zoho, as many of you know, is one of the most exciting and interesting and largest fintech companies in India. They're the largest online brokerage in India. I'm sure all of you have heard of it. Many of you probably use Zerodha if you trade in the Indian capital markets. Zoho is actually even today the largest revenue-based SaaS company out of India, right? I mean, all of you are probably familiar with companies like Freshworks and Druva and so on and so forth. Wingify and Fusion Charts are also SaaS companies. And then I'm sure those of you that are running, reasonably sizable startups already may actually be using a product like a MailChimp or a Basecamp. And Patagonia, especially if you live in the northern part of India, you may actually have bought something from Patagonia at some point. So the thing that all of these companies have in common is they are bootstrapped, i.e. they have never raised a penny of external capital. And that is fantastic, right? So think about this. One of the largest fintech companies in India and by far the largest online brokerage companies. So if you look at the segment of wealth tech as one of the segments of fintech, the largest wealth tech company in India is Zerodha. They are completely bootstrapped. And the largest revenue SaaS company as of today, even as of today, despite all this capital that has gone into SaaS companies in India, is entirely bootstrapped, which is Zoho, right? And the same thing applies for Wingify, Fusion Charts, Mailchimp, and others. So the first thing I want to sort of leave with all of you is you can build a company, right, without raising any external financing. And I think given the euphoria that we have about venture capital and venture capital, raising funding today, a lot of people forget that you can still very much build a very large company. Now, of course, it's going to take you longer, but the good thing is you're going to own a 100%. Of that company when you're through with it, right? The other question I always have, and again I do this sort of real-time interactive, it's a lot more fun to do. But I ask this question of what do these iconic companies have in common? Now these are companies you've all obviously heard of: Microsoft, Google, Amazon. Some of these numbers are actually not updated. I think Google sort of goes back and forth between 2 trillion and slightly above 2 trillion. Microsoft is clearly above $2 trillion of market cap. Amazon also, goes slightly up and slightly above and slightly below $2 trillion of market cap. And right here in India, we have a company like InfoEdge. I haven't updated these numbers, but 2-3 months ago they were at about $8 billion of market cap. And then you can look at a company like Atlassian, which is now worth almost $100 billion. And actually Shopify, I think, trades between 150 and $200 billion of capital, right? So I ask this question of what do these companies have in common? What's really surprising? These companies have raised very little venture capital funding, right? So today, if you actually, every single day you kind of, go to your favorite news source, could be your story, could be Economic Times, could be Inc42, and you're reading about these companies that are raising 50, 100, 200, $300 million of financing. Well, here's the news for you, right? Google, in its entire lifetime pre-IPO, raised $34 million of financings. 34 million. They raised an angel round. They raised a Series A that was led by Sequoia and Kleiner Perkins. And then that's it. After that, they went public. And that company today is valued at over $2 trillion, right? And the same thing is Amazon. Before they went public, raised very little venture financing, right? After that, they raised large amounts of, so public debt. They did new public equity issues. But if you look at how much financing this company raised, Amazon, before they went public, it's a surprisingly small amount of capital, right? InfoEdge is probably one of, is probably one of India's most interesting venture funded stories, because when InfoEdge raised $1.7 million of capital, and when Sanjay Bikhchandani and Hitesh took InfoEdge public in India, they had 1.4 million of that in their bank accounts. Okay, I want you guys to think about this. You raise 1.7 million and then you go public and you have 1.4 million of that left. Not surprisingly, the founders of this company and the management teams have created extraordinary wealth because they still own a large part of that company, as opposed to what you see today, which is, by the time a company goes public, maybe the founder is down to low single digits of ownership. That's not to say that's not a good strategy, but what I wanted to highlight again is that number one, you can build a company without raising funding. Number two, you can actually build extraordinary companies without raising huge amounts of capital. And I think today, especially in the current global context, in the Indian context of fundraising, we tend to, a lot of founders tend to forget this because you think that the whole game is really all about raising large amounts of capital, right? So I wanted to start with that because I think sometimes we forget that fundraising is not the objective. Okay, this is very important. Fundraising is not the objective. The objective is to build an enduring company that is going to have a massive impact on the markets that you serve, on the nation that you're in, or the world at large if you're trying to build a global business, right? So this is fundraising is a means to an end, not the objective, because today I worry that a lot of founders think that the objective is to fundraise. The objective is not to fundraise. And if you need any more data, here's a very important statistic for all of you. 20% of Chinese unicorns fail, okay? This is a big number. By the way, and I don't mean a company that is valued at over $1 billion in a private financing is now going to be valued at less than $1 billion. I mean it's valued at over $1 billion. Therefore, it is a unicorn, goes to zero, okay? So this is data from about 2 years ago in China. 20% of Chinese unicorns fail, okay? They go from being valued at over several $1 billion, in some cases 10 billion, 20 billion, they go down to zero, right? So again, if you think that raising funding is the objective, absolutely not. If you think that being to unicorn is a great sign of success, it is a marker, it is a milestone achievement for sure, but it does not guarantee success. What guarantees success is building an enduring business that over a long period of time starts generating enormous amounts of cash. Obviously, no startup will generate cash from day zero, unless of course you're a bootstrap company. Most startups will take many years of actually being able to finance the company before you get to profitability. But keep in mind that this is also important. So hopefully that gives you enough context that if there's a way for you to build your company without raising external financing, you should definitely, explore those paths. Okay. Now, if you are raising funding, which is probably why you're listening to this live stream, to this session, is questions you should ask before fundraising, right? The first is why do I need to fundraise, right? The second is, can I get to the next milestone without fundraising? The next question you might have is, how much do I need to raise? Another one could be, who should I raise from? What milestones do I need to reach before I try to fundraise, right? How long will it take to reach to raise the round? How many investors do I need to approach before I raise? And finally, what do investors look for? So what I'm going to try to do during this session is try to address each of these questions. I'm going to try to do it quickly, but I want to let you know that I'm a part of Sequoia and I'm part of the Surge team, and we put out a lot of content that you can find on the Surge website, on YouTube, on how to raise your fundraise. And right, so if you want to get into any of these questions in a lot more detail, just go. You should be able to find that content, from Surge, and hopefully it'll be useful to you as you go through your fundraising journey. Now, let me start with the first question, which is, how much do I need to raise? So first and foremost, keep in mind, there's no right answer to this, right? But the way we think about this is, there are good ways to think about this, answering this question, and there are bad ways, right? So let me start with the good ways, right? So the best way to think about how much do you want to raise is, how much do you need to get to the next milestone, right? Your next milestone could be, I want to get to a point where I can launch my product and get to product market fit. Or it could be, hey, look, I have PMF now. I need to actually scale it up so that I can get to meaningful level of traction, right? Where I can establish market leadership in a market, right? So you use this sort of way of thinking about it, right? Another one is, how much do I need for the next 18 to 24 months? One thing you should try to avoid is trying to be always in the market to raise funds, right? Sometimes I find that there are startups that are, literally every 6 months they're trying to raise. Now, the last 2 years, keep in mind, we have been in a very unusual sort of environment, both in India and around the world, where there's so much capital, right? Where companies do raise 2, 3, 4 rounds of, sometimes 4 rounds of financing in a year, which means every quarter you're raising a new round of financing. That is not normal, okay? What is normal is, you try to raise funding maybe every 12 months, every 24 months. So the other way to think about it is, how much capital do you need to last you the next 18 to 24 months? So for instance, one of the things we tell our Surge founders is, try to have about 2 years of runway, right? So you can look at, so how much cash do you need to have to actually keep building your company company for 2 years, so 18 to 24 months of runway. The other one, actually today, one of the reasons to raise funding, especially if you're an early stage company or a seed stage company, is to be able to hire, because the reality is talent has become very, very expensive, right? Hiring good engineers is a very expensive proposition. So unless your co-founding team, comes with, let's say there are 3 or 4 of you and 1 or 2 of you are engineers, in which case you can build something, you can get it out there, you don't need to hire a lot of engineers. But if that's not the case, then you probably do need to hire a few really, really good people, right? So those are good ways to think about how much do you need to raise. Now, there are bad ways to think about how much do you need to raise, right? What is the maximum I can get away with raising? In fact, on this morning, I was on a call with a set of founders who said, Rajan, we want to raise 25 million. This is a search company. I'm like, why 25 million? It's like, well, we think we can get away with that, right? That's not a great way to think about it. Because, if you raise $25 million, the investors that you raise $25 million from are going to have a set of expectations of what they want you to deliver with that $25 million, right? Another bad way to think about it is, what did my peers raise? And can I do something comparable, right? The average Series A used to be 5 to 7 million. Now the average Series A, let's say, is 10 to 15 million. So they say, hey, I want to raise 15 million because, I saw X, Y, and Z raise 15 million. Not a great way to think about it, right? And that comes to the last point, which is, what is the market for a typical seed Series A, right? So again, yes, if you're trying to raise a Series A, you should probably, think about that, start in that 7 million zone, but not necessarily, not everybody should be raising $15, $20 million Series A's, because keep in mind, if you do that, you're going to have to deliver the results that your investors want, because they have effectively invested a Series B quantum of capital at Series A. Similarly, in a seed round, right? Maybe what you really need to do is raise 2 crores or 5 crores or 10 crores. Not everybody needs to raise 20 crores, right? So a lot of people today, a lot of founders today are trying to raise 20 crores. So again, use this sort of framework to think about how much do you really want to raise, right? How much do you need to really raise? Now, the next question is, who should I raise from, right? So again, the simplest way to think about the answer to this question is, who you should raise from depends on how much you want to raise, okay? So let's say you're just getting started and you raise 20 or 30 lakhs or 50 lakhs just to get going, okay? If you happen to have friends and family, and I say who have the kind of disposable income where they can actually invest 30 lakhs, 50 lakhs in your business, that's the fastest way to get off the ground. And that's what we see that's most common. Now, I do realize that many of you may not be in that situation where you can go, get 30 or 50 lakhs from your friends and family, right? In which case you have to then find, these other ways, right? Grants. Here's an interesting statistic for all of you, okay? The government of India, both at the center as well as in each of the ministries and across all of India's states, has 14,000 crores of funding that is available for startups. Very few startups actually know about this, right? So, and by the way, you can't go and raise 20 crores, but if you're trying to raise 25 crores, 50 lakhs, up to 1 crore maybe, right? Please make sure that, and you're a very, very early stage company, please make sure that you take the time to understand how you can access which pockets of financings from the government. And in fact, the Startup India team is, can help you guys with that, right? Third is, angels and angel networks, okay? So let's say you're trying to raise 1 crore, maybe 2 crores, 3 crores, maybe up to about 5 crores. Today, there are a large number of angel networks, and there are also platforms, right? So Let's Venture, there are angel networks like Indian Angel Network, Mumbai Angel Network, Chennai Angel Network. And then there are platforms, AngelList is in the US, AngelList is also here, but India's leading platform is Let's Venture, right? Let's Venture does about 2 investments every week. So let's say you're trying to raise 1 crore, 2 crores, or 3 crores. You should actually list on that platform. You should figure out how you can raise from a platform like a Let's Venture or an AngelList. And you should definitely apply to Indian Angel Network and all the other angel networks, right? And there are also lots of super angels in India today, right? There are probably 30 to 40 super angels who will do more than 10 investments a year. Try to do the research, try to identify them, try to get referred to them and reach out to them. Then there are seed funds, right? There are micro funds. There are probably about 10 very, very good, hugely active micro funds, right? Could be Titan Capital, could be Better Capital. So do the research on these firms, and they can fund between 50 lakhs to 1 crore to 2 crores. And then there are seed platforms, right? Like for instance, Surge is an early stage fund, and we will invest $1 to $2 million into very, very early stage companies, right? 30% of the companies that we invest in are actually pre-launch. So explore those. Then you actually have sort of in many ways the early stage funds, right? So Surge is a part of Sequoia, which is a venture capital firm. We invest from idea through IPO, so we're pretty broad spectrum. You can look at similar firms like Accel or Lightspeed or Elevation or Matrix or Nexus, right? These are early stage funds. Now, if you want to raise, let's say, a Series B, you're trying to raise $25 billion, $30 million, $50 million. Now you get into basically the growth stage funds, right? So these are the later stage funds. And if you're in that group, you should know, I'm sure if you're already in that place, you know exactly which firms to talk about. So I'm not going to spend much time on that. And lastly is, look, venture debt, right? Venture debt is available to startups that have already raised at least one equity round of financing, right? So I would say if you've raised, let's say 20, 25 crores at a minimum, you're going to be eligible for venture debt. And you should explore that, especially to fund things like working capital, right? If you're trying to find, funding working capital requirements of your company by diluting equity is not a great idea, right? So hopefully that gives you some context and framework of how to think about who you should raise from. Now let's get into probably what's most important, which is what are investors looking for? Well, firstly, keep in mind that what investors are looking for depends on the stage of your company. Okay, at seed stage, it really is entirely going to boil down to team and the market, right? How capable is your team? How compelling is the team? I'm going to talk a little bit more about that. Is there really what we call founder market fit, right? And that's going to be very, very important. The second is the market, right? Investors are going to ask themselves, hey, look, is this market big enough to build a very large company? And finally, if you got a product, if you've launched a product, then they're going to actually look at the product. Otherwise, having some, if you can, especially if you're building a digital business, it's a little harder to do if you're not in a digital business. Try to get something out there, right? So that, if it's an app or if it's a SaaS product, get a version one out there so that investors can look at it, right? So in many ways, at seed stage, what investors are really looking for is the story, right? It's your story. Why are you building what you want to build, right? What is the market? What is the pain point? In many ways, so that's what you're looking for. However, when you go to Series A, investors are still going to look at the very same things, right? Is the team. Now it's not just the founders, but if you actually hired a team that is actually very, very strong, they're going to go much deeper into the market and really try to understand, hey, look, are there enough, is the market large enough to build a large company? Are there enough needs to be met? And then finally at Series A, they're going to look for either product market fit. Very clearly, you can say, yes, there's product market fit. I'm going to talk about that. Or are there early signs of product market fit, right? And then finally, look, if you want to really raise, quickly be able to successfully raise a Series A from top tier investors, having strong traction really helps, right? So the journey of this is, you start with a story. It's a story about you, and it's a story about this problem you're trying to solve. You very quickly have to get into some proof, which means launch something, get to early signs of PMF, and then finally you need to have metrics, right? So that's sort of the simplest way that you should be thinking about this. Now, let me talk a little bit about what do investors look for in a founding team or in a founder, right? Firstly, founder market fit. This is very, very important. A lot of seed stage founders don't understand this concept. If you don't, please spend time trying to understand this concept, because it's the first question that investors are asking themselves, right? And the simplest way I think about it is, what is this team's right to win in this market? Okay, Byju's was an educator. He was a phenomenal educator. Number one, he understood the education business. Secondly, he knew how to deliver education to fill up stadiums of 5,000 people, right? Byju's was not some hotshot developer who came out of, name your favorite company, Google, Facebook, Amazon, that all of a sudden said, I want to build a huge tech company, right? So being deep in the education space was very, very important. And then over time, he built, an app and built a team. And now you know the story of Byju's, right? Freshworks, Girish and his co-founder, they came from Zoho. They had built, shipped, and scaled SaaS companies, SaaS products rather, right? So when they left Zoho to start Freshworks, they actually had lots of experience and capability in building SaaS products, in marketing SaaS products, in hiring sales teams, and so on and so forth, right? So founder market fit is very, very important. I'm glad to answer many more questions. Ask yourself, if you're a seed stage founder, or you're a seed, if you're an early stage founder, right? Ask yourself this question of, do you have, can you articulate the founder market fit of what is your right to win in this business? By the way, it's not always necessary, but it helps a lot. So that's number one, right? Second is core functional expertise, right? Especially if you're in the tech space, for instance, right? Having a founding team that is a good mix of product engineering and GTM, that's a home run. Okay. So yeah, last night we actually met with a SaaS company where there are 3 co-founders. It's a pre-launch company. Okay, 4 co-founders, right? One is business leader, one is a product leader, one is an engineering leader. Like right off the bat, that's interesting to us because you have the set of functional expertise that can come together to very quickly be able to launch a company, right? The third one is unique insights. This, I can't emphasize this enough. Okay, when you're pitching to investors, they're looking for unique insights you have about the problem that you're trying to solve. Okay, this is very, very important. Generic pitches fall flat completely. Try to really think about what are the unique insights that you have about the problem that you're trying to solve, the unique insights about the customers that you're trying to serve. That's going to get investors very, very excited, right? Perseverance, right? This is very important. Look, the reality is, whether you like it or not, it's going to take 10, 15, 20 years to build an awesome company, right? Vijay Shekhar Sharma, I hosted a fireside chat with Vijay yesterday. Vijay launched his company in the late 1990s. Okay, it's been all 24 years since Vijay started his company, right? Now, obviously, Paytm is still just getting started. They just went public. So the next 10, 15, 20 years, they're going to build a public company. But the reality is he started this company, Zerodha. The Zerodha was started in 2010. That's 11 years ago. Now, what investors are looking for is, are you going to have the perseverance to keep building for that long, right? So they're going to look for that. Missionary, not mercenary. Very, very important, okay? You're going to be this question of, why are you building this company? And the answer can't, think about that, right? Because if you're going to dedicate, if this is going to be your life's work, right? Founders, this is going to be your life's work if you're going to build a great company. You have to have a strong reason for why you want to build this company, right? It can't be because you want to build a cool product. It can't be because you want to be, make $100 million. That might be an outcome of building a great company, but I'm telling you, that's called, if all you want to do this is, building a startup just to make money, I've rarely seen that be successful, right? Simply because it's going to take 10, 15 years. You're going to go through 4, 5 near-death moments. And in those near-death moments of a company, what's going to keep you going, what's going to keep your team going is that mission. It's the reason that you got started, right? Ambition. Look, investors want to sort of see founders who want to build very large companies, okay? If you want to build a small business, that's good lifestyle business, investors are not going to care about it. And lastly, look, they want to try to understand, is this a team, a founding team, that is going to be able to build a very strong team? And is this a team that's going to be able to execute? I know it's a lot, but this is what, look, at the end of the day, at seed stage, the entire bet is on the team. And this is what investors look for, in a team. Look, what do investors look for in the market? Okay, at a simplistic level, look, they're trying to say, is the market large enough to build a large company? Okay. Now, the second bullet point here on this page is very, very important. Okay, building a 100 crore revenue company in 5 to 7 years works for you. It does not work for venture capital investors. Okay, because a lot of seed stage entrepreneurs, early stage entrepreneurs don't understand this. So let's say you're in a market and a space that you understand really well, and your goal is, look, in 5 to 7 years, you want to build a company that's got 100 crores of revenue, and it's going to generate 30 crores of net profit. Okay, so every year you're going to be able to take 30 crores home. That is a fantastic lifestyle business, but it is not a venture fundable business. Why is it not a venture fundable business? Because any venture capitalist that's looking to invest in a company wants to see a very large outcome. You'll hear this word outcome, right? Outcome means a company that's going to get to at least a few thousand crores of valuation, ideally over $1 billion of valuation. Because that's just how the fund math works, right? So this is very, very important, right? If you're going to pitch into investors, let's say you come pitch to us and you say, hey, look, Rajan, 7 years from now, I'm going to get to 200 crores of revenue with 50 crores of profit. You're probably feeling pretty good about that. That meeting is, over, because, that's not really a business that we want to fund, because at 50 crores of profit, even if you multiply that by, 40 times, 50 times, you end up with a company that's going to be valued at 2,000 crores. As Sequoia and as Surge, that's not interesting, because we want to see a company be able to have the potential to get to be at least worth $1 billion, right? So this last point is very, very important. Venture capital investors ask this question: can this be a $1 billion valuation business? Okay, that is a question. They may not ask you about it. They may not frame it this way, but that is the question that they're asking. Okay. So when you break that down and when you peel back the onion on that, right? Can you show a path to $100 million revenue company with strong unit economics, right? So regardless of the business, at least $100 million of revenue with strong margins is going to be required if you're going to be valued at $1 billion, right? Now, keep in mind, this is $100 billion of revenue. It's not GMV, right? There are lots of fancy terms out there. Gross merchandise value, TPV. Yesterday, I heard another term called GTV, right? Look, I'm talking about revenue. There's only one real way to measure revenue, okay? It's real revenue. So, and by the way, the 100 million is a minimum. For instance, if you're trying to build a D2C business, and you want the D2C business to get to a point where it could be valued at $1 billion, you're looking at 3x to 5x revenue multiples, assuming your gross margins are strong, your unit economics are strong, et cetera, okay? So that means if you want to get to $1 billion, you probably are looking at $200 million to $250 million of revenue for your beauty company or your food company or whatever. That's a lot, okay? $250 million is basically, getting close to 2,000 crores of revenue, not 200 crores of revenue, right? And our gross margins do matter and long-term profitability matters. Now, it's not important in the early days, but your investors are going to try to understand, look, it's a business that can actually generate decent gross margins, right? So before you pitch to investors, make sure you understand the scale that actually excites investors. Another important question is timing. Timing meaning why now? You'll hear this term, why now? What does it mean? It means why is now the time to be building this company, right? So for instance, I'm going to take Katabook, which is in our first cohort of search. Phenomenal company. It's basically an SME SaaS company. It's a SaaS company focused on Indian SMEs. The reason Katabook was able to get to 10 million merchants, small businesses in India that use the product, is because they timed it well. The timing was right. What happened? Well, basically Android had basically permeated 500 million users. Jio had launched, which made broadband very affordable. All these small business owners, right? So first they got a smartphone, they started using things like WhatsApp, then they went to YouTube, then it started search. Then right about 2.5, 3 years ago, they started being open to using productivity software to improve their businesses. And then Katabook came along, launched a very simple app, then a small business app, and then boom, it took off, right? So 10 million merchants in India today use Katabook. Now, if Katabook had been launched in 2011, right, before Sequoia, I was at Google. 2011, I joined Google. All of India had 100 million users. Data was very, very expensive. Smartphones were very, very expensive. If Katabook had been launched in 2011, wouldn't have been successful. Katabook will be successful, was successful today. So why now is very important. Think through how you want to articulate the why now, right? If WhatsApp, for instance, didn't exist and WhatsApp didn't have 500 million users on its platform, it would have been very, very difficult for Vidit and his co-founder to build Meesho. Okay, so investors are thinking this question, why now? So if you can proactively articulate why now, then I think you're going to be in a better place. And it's also an important question for you to ask, right? Is the timing right for the kind of business that you want to build? Now let me get to the next thing that investors look for is product market fit, okay? This is the holy grail for a seed stage startup. If you're a seed stage startup, your only objective, okay, your only objective is to launch and get to PMF. If you don't have PMF, please don't try to raise a Series A, because every single company that I know without PMF that raised Series A pretty much went nowhere, okay? Because without getting PMF, you're actually not going to be able to scale the business, right? Now, if you have launched and have some traction, this is the most important question that investors have. Are there early signs of product market fit? Now, let me talk about what do you mean by, how do you know whether you have product market fit? The simplest way to think about it is, do you have user love, okay? Do you have user love? And if you want to put that into some metrics, it's really about retention. Retention is the metric, right? So think about PMF, think about retention, okay? So high growth with low retention is a very bad sign, right? Actually, about 6 months ago, we invested in a company. There were several players in this space, okay? There was one company that had only 5,000 users, but had very strong retention, very, very small number of users, There was another company in that same space that had about 1 million users, but very low retention. Guess which company we invested in? We invested in the one with 5,000 users, because high retention shows that you built a product that customers love, that they'll keep using, right? And if you're a B2B company, by the way, investors will talk to your customers to see, are you meeting a real pain point? Do they love your product? Will they renew your contracts? Things like that, right? So PMF is something that investors, especially if you're a company that's already launched and you're in market, investors are gonna look for this, right? This is called a retention curve. If you're not familiar with this, please drop everything that you're doing for the rest of the day and just go and study retention cohorts, retention curves. Doesn't matter if you're building a B2B business, doesn't matter if you're building a B2C business, doesn't matter if you're building a D2C company, doesn't matter if you're building a healthcare company. Retention simply means Customers, once they use your product, will they buy it again? And ideally, they should keep buying it, right? Now, there are 3 lines here. I'm not going to get into this in the interest of time. The black line is bad. It's called a declining retention curve. It means eventually you will have 0 customers. If you acquired 100 customers today, the black line says in X number of months, maybe 3, maybe 6, maybe 12, you're going to have 0 of those customers with you, right? Black retention curve is not a fundable business. The gray curve is what we normally see, which is called a flattening retention curve. Okay, it means that if you have 100 customers, if you're an SME SaaS company, and by the way, these curves look very different by business. Okay, this is not a curve that applies to all businesses. If you're an enterprise SaaS company and your retention curves looks like this, you're toast. You are toast. If you're an SME SaaS company and let's say SME SaaS company in India, okay, SME SaaS company in India, like a Khatabook, a Pagabook, a Leo, right? And your retention curve looks like the gray line, you're actually in decent shape, not great shape, because I'd love to see that gray line, plateau out at about 30%, not 25%. At 40%, you're like killing it, right? So that's pretty good. So it's very industry specific. And then the green line is called a smiling retention curve. What it means is, you plateau out, but then over time, you start reactivating users, right? So this is really, really important. And I'm assuming at least some of you will be familiar with it. But if you're not familiar with it, please take the time to really understand in a lot more detail. Now, if you have revenue, you should show your unit economics, okay? Because keep in mind, you can also get revenue by losing lots of money, right? And keep in mind a few things, okay? I hate to generalize, but I think it's going to be useful to many of you. High gross margins make investors smile, right? When I see high gross margins, I smile. Negative contribution terrifies them, okay? Yesterday, I saw a company which had seriously negative contribution margin. That terrifies investors, right? Now, not knowing your numbers makes the meeting end early. Please make sure that you really, if you're going to pitch to investors, please make sure you understand your numbers in lots and lots of granular detail, right? And I think, look, I wrote this last year when I said the era of growth of cost ended in March 2020. Now with this in 2021, in many ways, that era started coming back, which is a bit worrying to us, obviously, right? Now, if you're an early stage company, keep in mind, you are now in 2021, right? 2021, global interest rates are going up. Bunch of things are happening around the world. It's unclear how long this party, when I say party, this unprecedented funding boom globally and in India is going to last. So I would be very, very cautious about growth at any cost, right? Other question we get, by the way, is how many meetings to raise your round, right? Dream11 is India's leading online gaming company, right? Last round valuation as per media was over $8 billion. How many meetings did Harsh, who's the founder of Dream11, have to raise his Series A? Okay, Harsh raised his Series A in 2015, which was 6 years ago, and he raised $5 million. $5 million. Okay, so today's context, it's actually a pretty small Series A, right? But actually, not really. $5 million is a pretty significant Series A even today. How many meetings? And remember, this is a company that is now worth $8 billion and the leading gaming company in India. Okay, 6 years ago, he raised his Series A. Harsh Jain had to have 105 meetings to raise his Series A. A lot of founders think that they pitched to 6 or 7 investors and they've all said no and they're disheartened. I have news for you, okay? The headlines that you read that, I only had 2 meetings and I raised my round. Yes, that does happen, but very, very rarely. For most of you, you're going to have many, many meetings. I don't know. Some of you may actually end up having 100, 150 meetings. I wouldn't put it past you, right? My only counsel to you is this idea of only having 5 meetings and raising your round. That's a myth. So get it out of your head and get ready to hit the road and meet a large number of investors, right? So even for search companies, many of them, some of them are either in a strategic market or they're growing so fast where, with a handful of meetings, they're able to raise a large Series A. But for many of them, you have to have a large number of companies. So even if you're trying to raise a seed round, my message to you is this is not 2, 3, 4, 5 meetings, okay? I talk to a lot of founders, they've had 8 meetings and they're disappointed. They think that this is not working. Well, I have news for them. Just keep in mind the Dream11 story. Okay, how long will it take? Well, look, it's going to take you time. Okay, in an absolute best case, it might take 3 or 4 weeks to raise your seed round. And this, by the way, could be 1 crore, could be 5 crores, could be 20 crores, right? I'm talking about like a seed round, right? But at the end of the day, look, that's a best case, and that is very unusual, right? The reality is, look, if you're trying to raise 2 crores, you should budget maybe 2-3 months, right? If you're trying to raise 20 crores, you should probably budget a little more than that. Could take as much to 6 months, hopefully not, because the markets are very hot today, right? And then finally, look, if you're trying to raise a very large round, it could take you much longer. Now, these are normalized timeframes. Currently, we're living in a period which is very unusual, where there's so much capital. It's much easier. But keep in mind, right now, the period we're living in, this is not the normal, okay? What we're living in right now, this is unusual. The normal periods are the timelines that I have today. But regardless, look, if you're trying to raise a seed round or an early stage round, you should budget for at least a few months. And that's why it's important when you do raise enough capital so that you have 2 years worth of runway. Finally, look, we have a whole session on pitch decks. You can go do a search for Peter Kemp's, P-I-E-T-E-R, Kemp, K-E-M-P. Peter Kemp's actually does a fantastic session around how to put a pitch deck together. He's a Surge. He's one of our investing team members, leaders in Surge. Please go, find the videos. Keep watching Peter Kemp's videos. But this is what you need to have in a pitch deck, right? So company purpose. You need to sell the problem. Please keep in mind, sell the problem before you talk about your solution, because investors really need to understand what problem you're trying to solve. The why now, just have one slide, clearly think through why now. Talk about your market size, how big is it? Talk about your business model, and keep in mind at the end of the day, especially at the seed stage, the bet is on you, right? If you're a single founder, it's on you. If you're a co-founding team, it's on the founding team. Also, don't forget to talk about your competition, and please clearly outline future is both next 6-12 months, because if you're a seed stage company, that's going to matter. But as well as, what is this company going to look like 6, 7, 8, 9 years down the road, right? Keep in mind, investors will not invest unless they believe you're going to become a $1 billion valuation company, whether you like it or not, especially venture investors, okay? Now, lots of angels will invest if they think you can get to maybe 300-400 crores. You don't need to raise a lot of capital. They're going to invest 50 lakhs and they might be able to walk away with a few crores of returns. You don't need to build detailed spreadsheet models, okay? If any angel investor or seed fund asks you for detailed spreadsheets, they're the wrong investor for you. Please don't take money from them. That being said, you need to think through and articulate how big your company can get. The 5 P's for a perfect fundraise: prepare materials. That's very, very important. Prepare your pitch. Practice will make you better. It's like anything else in life. Practice, practice, practice. Try to target, okay? And let me give you one example, right? Not all investors invest in everything. For instance, if you're trying to build a medical device company, coming to Surge or Sequoia is not really a good thing to do, because we don't invest in medical device companies, right? Not because we don't think it's interesting, because we don't have expertise. But at the same time, if you are building an ag tech company or an ed tech company or an digital health company or a SaaS company or a developer tools company, security software company, you should come to us, because those are all sectors that we invest in. Direct to consumer brand company, right? However, if you're trying to build the next big breakthrough biotech company, coming to Sequoia or Surge is not going to help, because that's not a segment we manage it. And finally, look, if you're going to have 50, 100 meetings, managing your pipeline carefully is very, very important, right? You should look at this like a sales process, much like a salesperson would have a CRM system, build a pipeline, etc. You need to do that. And finally, keep in mind, patience is very important. Keep in mind the Dream 11 story and how many meetings Harsh needed to have. Lastly, look, have no ask. What I mean by that is focus on the amount you want to raise. Your investors that you're talking to will push you to give you valuation guidance, right? They'll say, but come on, tell us, what is your valuation? Just stick to one thing, okay? Just tell them, look, you're looking to find the right investors who are excited about your business. Do not give a valuation guidance, because the reason is because valuation really is a buyer-seller thing, right? I mean, at the end of the day, you should have a number in your head, but do not put it out. In fact, this morning I was talking to one of our founders saying, why did you say the number that you're expecting? Because you're scaring off investors. You should not be scaring off investors. Get them excited about your business. Get them excited about your investing, right? And then make sure that they understand how much you want to raise and why they want to raise it, right? Please don't tell them who else is looking at your company. Bad practice, because you know why? It's a very small world. We all know each other. If you happen to tell us that somebody else is looking at it and gave you a term sheet and they haven't, boom, your deal's not going to happen, okay? Be authentic, be real, be yourself. Don't try to be somebody else. And finally, please don't make things up, okay? Say it like it is, because as investors, look, we do this for a living, okay? We do this for a living. Today, I will meet 8 founders, 8 companies, one day, me. So imagine how many companies that our team at Surge is meeting, okay? Like a massive number just today, and so we can see through things, right? So say it like it is, be very truthful. Don't make things up. With that, wish you all the very best. I think you're embarking on a very exciting journey. I know many of you are probably already well on your way to building your company. And we wish you all the very best. Okay, with that, what I'm going to do now is try to take some questions. I'm going to stop sharing. And Diksha, maybe you could let me see here. Did you guys put the questions on chat? And Diksha, how much time do we have left?
Another 10 minutes, so.
About 10 minutes. Okay, I think 9 minutes, right? So we'll say we'll wrap up at 11:45 India time. So let me see what questions are in the chat. We find it difficult as an early, so I'm going to read out the question because you guys may not have it. We find it difficult as an early stage company to decide how much equity to offer for a given amount of funding. How should a startup ensure that they do not give away too much of their share? Okay. So first of all, look, if you're an early stage company, and let's say you're trying to raise 50 lakhs or a crore, you don't want to give away 30% of your company. Okay. So first of all, there's no right math, right? At the end of the day, look, you should try to sort of give away as little as you can, but also keep in mind, if you're like haven't launched yet, you're trying to raise 1 crore from a micro fund, right? They're going to probably want 15% of the company. That's not hugely unreasonable, right? You can think about Y Combinator, right? Startups that apply to Y Combinator, right? They give up 7% of the company for $125,000. Now there's 500K. The rest of it is actually convertible note, which is fine, right? So it really depends on how much, but what we would say is definitely don't give up more than 35% of the company because you won't have anything left, right? Because if you're an early stage company, you're going to raise your first round of financing, then you're going to have to raise many other rounds of financing, right? And you don't want to be that founder where 5 rounds in, your equity ownership in the company is down to 3%. That is not a great place to be. Next question is, as a startup from tier 2 city, should we be doing something different when approaching investors? Look, it doesn't matter today which city you're in, right? I think you should follow a lot of the things that we talked about in this session, right? I would spend a lot of time trying to understand. Look, at the end of the day, like I can speak for Surge and Sequoia. Okay, we don't care what tier city you're coming from, whether you're based in Bangalore, whether you're based in Jaipur, whether you're based in Alibag, whether you're, I mean, look, you know, whether you're based in, you know, wherever, right? What we care about is number one, are you an awesome team? You know, is there a strong founder market fit? Are you guys ambitious? Do you have the right set of skills in your team to be able to build and scale a company quickly, right? And then if you've launched a product, then we want to understand, is there early user love? And then most importantly, we want to see, look, is the market large enough to be able to build a very large company? So hopefully I answered that question. Look, we would love to see many more Surge applications from tier 2, tier 3, tier 4, tier 5 towns, right? Okay, third question is, in uncertain times such as the current pandemic, the 4 to 6 months future scenario may not be clear for all sectors. In such cases, how should startups ensure the funds they raise can actually put to the intended use and are not wasted or don't remain used? Yeah, it's a great question, right? Look, I think in the uncertain environment that we're in, you know, I tell a lot of our founders, this is a great time to fundraise, but please don't go spend it all. Because, you know, it's very unpredictable, right? I mean, like Omicron, how long will it last? You know, 2 months, 3 months, will there be another wave? We don't know, right? You know, if you're, let's say, in a highly impacted sector, like a travel or hospitality or offline retail or construction tech, right? So you don't know, like, whether it's going to be. So try, you know, it's a good time to raise if you can raise the capital, but be cautious about how quickly you spend the capital. Those are some of the questions. Are there more? Oh, there are more here. Okay. Let me keep going. How to articulate an elevator pitch to create that first impression. Elevator pitches should be maybe 2-3 minutes, and you should try to articulate, you know, focus on the things I talked about. Okay. What's your background and what's your story? Why is there founder market fit? What's the problem? Sell the problem very quickly, right? What's the problem you're trying to solve? And if you've already got a solution, talk about it. So it's really, I mean, an elevator pitch, right? Is, you know, I talked about the anatomy of a pitch deck. Let's say a pitch deck. Our pitch decks, the first meeting that I do is always 30 minutes, okay? That's all. And I expect the founders to maybe go through their thing in maybe 18, 20 minutes, and then 10 minutes of questions. Sometimes it goes 25 minutes. We don't have much time for questions. So the simple way to think about it is you want to take all of that into 2-3 minutes, right? An elevator pitch really shouldn't take more than 2 minutes. You know, I find it quite fascinating, right? I always attend these Y Combinator demo days. 1 minute is all you get as a YC startup. You get 1 minute to pitch the company. It's amazing. So those of you that haven't seen it, try to find that 1 minute pitch. I think if you can do it in 1 minute, fantastic. And quite frankly, you know, in 2 to 3 minutes, if you can't describe what you're trying to do and your team to make it very compelling, you're missing the plot. Okay. What is the turnaround factor that the investor is looking for in a startup when they go in for the next round of funding? So I don't understand what that question is. But look, as early stage investors, we are investing in a company with an 8, 10, 15-year horizon. Okay. If an investor wants to see returns in 2 or 3 years, they're a bad investor for your early stage company, okay? Because there's no way you're going to be able to return their capital in 2 or 3 years. So make sure that whoever you're taking your capital from, especially if it's an angel investor or it's somebody that's, I mean, look, all venture capital funds understand this, okay? They have a 10-year plus horizon. We have a 10, 12, 15-year horizon, okay? But if you're taking capital, let's say from friends and family, or taking money from angel investors, make sure that they understand that they're not going to see any capital back for a long time. And startups are very risky, okay? Startups are very risky, which means most companies fail. So if you're an angel investor and you're assuming that every company is going to return capital, that is a bad assumption, which means that's probably not an angel investor you want to take capital from. Try to avoid new angel investors unless they're investing with others who are very experienced. Because sometimes new angel investors don't understand this dynamic, right? Most startups fail, which means most capital that you invest in an angel investor are going to go to zero. But the real benefit of the value you get from a return standpoint is 1 out of 10 could become a huge hit, right? And then boom, you make huge amounts of return. How important is it to have tech expertise in a founder mix for a startup? If you're in D2C or food, not as important. It helps. Look, the reason it helps, I would say it's not critical, but it does help. The reason it helps is today, it's so difficult to hire engineers, right? And if you don't have an engineer on your team already who can hire other engineers, it's very, very difficult. So we've seen, it's not a non-starter. Like if you're building a SaaS company and you don't have a tech co-founder, that's a non-starter for us. Okay. If you're building a D2C company, you don't have a tech co-founder, it's not a non-starter. But it helps, at least if you have an engineer, maybe it's not a co-founder, but you have an engineer, because otherwise, who's going to build your product? You're going to have to outsource it, which is okay to start with. But, I mean, today, right, hiring engineers is the hardest thing in India. Other questions? I think we have about 3 minutes left. I think I've taken all the questions, right, Diksha?
Yes. Yeah.
Okay, I think we have 2 minutes to spare. Shall we wrap up?
Yes. So any last piece of advice for the audience you have today?
No, I mean, look, I think I will leave with this, right? Look, there has never been a better time to be an entrepreneur in India, right? So I think all of you know the statistics, unless you've been living under a rock. We had over 40 new unicorns in India last year. Now we have over 70 unicorns. We had $35 billion of startup funding that came into the ecosystem. That was 3.5 times the amount that we had in 2020, and it was 2.5 times what we had in 2019. There's no better time to be building a startup, but make sure that you're doing it for the right reason, okay? You have to be missionary. Keep in mind, this is going to be your life's work. It is going to take you 10, 15, in some cases, 20 years to build this company. So it needs to be a missionary. It needs to be a life's work. You need to really, really want to do this. And then second, look, make sure you're solving a really important problem, right? Meaning it's a real problem to solve. And as soon as you can, try to get validation that the solution that you built to this problem is really going to stick, which is i.e. PMF, right? And then on funding, hopefully what I've shared with you today has been helpful. And with funding, all I can say is just stick with it. Look, entrepreneurship is all about perseverance. You have to keep going, keep going, keep going, and keep going. And with that note, Diksha, I'm going to get going.
Thank you so much, sir. This was indeed a very insightful session. I'm sure the audience must have benefited from it. Thank you again.
Thank you, Diksha. Thank you, everyone. Take care. Have a great day.